You talked about the broadening out, but what do you make of the valuations at mega cap tech? Do they still remain elevated? And NVIDIA, of course, serves as a reminder to us all of the equity concentration risk.
Yeah, well, it's not just the top 7 or 8 stocks. I mean, we have high valuations kind of everywhere now. We wrote about that. So that is our chief concern. And by the way, valuations are very hard to predict in the short term. I think we'll see some volatility there. Now, within the Mag 7 or the top 10 stocks, we've seen some dispersion there as well over the last 6 months. In other words, the market is betting more bullishly on certain individual names there and punishing others. I think that's going to continue. The best thing I can say about that concentration risk, as long as there's not a shock, okay, a rate shock or a growth shock, that money can reallocate, right? That's the fuel for the broadening out. We saw it this summer, quite frankly, where those stocks underperformed in July, and then the small cap stocks had their best month of the year.
Mike, what could go wrong in the present setup, and what could be the catalyst for a correction? And have you got a line of sight on potentially how deep it could be? And would that be classified as a healthy pullback and one that you would want to take advantage of?
Yeah. So I would say 3 things. Number one, price itself. So to your point, valuations are rich. We reached sort of a short-term technical target around 6,100, which the market did react at. So that's sort of risk number one, just price exhaustion of the move. Okay, we can't keep going up at this pace. Number 2 is the term premium within the bond market. So over the last, I'd say, 4 months, I mean, rates have backed up a ton, but the term premium has remained somewhat stable. Okay, and I think we're waiting on Treasury Secretary announcement to maybe see how that behaves. If the term premium were to widen out, I think that's a risk for multiples. And then the third one, I think, is the dollar.
So a retest of 5% on the 10-year yield could be a problem?
Or the mix. So in other words, if rates stay here, but it's more about term premium as opposed to better growth, I think that will weigh on multiples, and we've been pretty explicit about that. But yeah, clearly a 5% 10-year, that's not in the price of stocks, okay? But that's a risk, potentially. And the third one is the dollar, which, initially, which I think is maybe correct, is that the dollar has been quite strong post the election. But now we're getting into an area, the dollar versus other currencies, where it could be a headwind for earnings growth. And we're going to hear about that, of course, when companies report their fourth quarter. So those are the 3, I think, near-term risks.
Mike, let's bring in the tariff risk, because that has implications for consumer discretionary, consumer staples, their pricing power, and then, of course, for the multinationals on the S&P 500. How are you gaming that out?
So this is probably the $64 trillion question on the first half, the sequencing of these changes, right? So it's pretty easy to see immigration being hit right away, meaning enforcement of the borders. Okay, that's a net negative for growth. The second one, of course, is tariffs. President Trump-elect is definitely been very specific that he's going to be going after tariffs initially. So those are 2 sort of net negatives, specifically for the areas you mentioned, consumer discretionary, where there's tariffs being hit, and some of the multinationals as well. And then the good stuff of perhaps some of the change, like cost cutting on the government, getting the budget under control, deregulation, that may take a little bit longer, which once again is why we're a little less optimistic perhaps in the near term, even though perhaps we think this could all work out by the end of next year.